Picture this. I click on the keyboard to enter into a trade and boom, immediately TradeStation shows me a positive P&L. Am I that good of a trader? Nah. Right? I just know the right way to get paid to trade. In this video, I'm going to let you in on a little secret of mine. The world of credit spreads. It is a nifty strategy that not only allows you to get paid for your trades, but it also serves as the foundation for understanding more complex options strategies like iron condors, butterflies, and much more. This video is going to be part of our cash flow series. So if you want to check out some of our other cash flow strategies, go ahead and click right here to check those out. Ready to get started? Let's dive right in. All right, first things first, what is a credit spread? A credit spread is an opportunity for me to buy and sell an option at the same time, taking a credit, a premium, getting paid up front to place that trade. I minimize my risk in that trade because I have multiple directions the position can move and I'm still profitable. If I do a spread and my expectation is the stock going up, if the stock goes up a lot, I make money. If it goes up a little bit, I make money. If it goes sideways, I make money. If it goes down just a little bit, I still make money. If it goes down a lot, that's where I tend to get in trouble. They're an amazing strategy, one that I love and use all the time. The beauty of credit spreads is their flexibility. We have two main types of spreads. One is called a bull put spread and the other is a bear call spread. They allow you to play both sides of the market, bullish and bearish. Let's talk about the difference of those two spreads. First off, let's talk about the name of the spread, a bull put spread. 3 words. Bull, bullish trade using puts, spreading out your risk with options. Bull put spread. We use a bull put spread. The first word tells you what it is. You are bullish. You believe the stock is going up. That is where we would enter into a bull put spread. Unlike a bear call spread. Bearish trade using calls, spreading out our risk with options. So let me walk you through an example of a spread. And we're going to use one that is a bull put spread. That's the trade we're going to start off with. So I'm going to bring over my Word document and we'll kind of lay it out right here on this page. All right. So as we go over here, we're going to look at a bull put spread, BPS, bull put spread, and we're going to do it on a stock symbol. We're going to just say on Apple, right, as an example, right? Doesn't really matter who it is. We use this as our way of trading this. We're going to have 2 different positions that we're going to use. A sell to open, which will be abbreviated as STO. And we're going to have an option that's a buy to open. Yep, so you guessed it right. BTO. Right? So what's going to happen there is if Apple, let's just say we're going to make it up. I don't have the exact price today, but let's say Apple is at $200 right now. We're going to go ahead and we're going to sell an option that is lower than the price of Apple. And we'll be using things like Fibonacci levels, support and resistance lines. We're going to be down below some key level of support. Okay? So we're going to sell to open. I'm going to actually put this down on another line. And we're going to just do STO. Right? We're going to sell to open, let's say the $195 put. What just took place there? If I sold this, someone's going to pay me, right, my credit. I'm going to make it up, okay? Let's say it's $2 that somebody pays me for my credit in this transaction. So what now is required of me? I am now obligated that somebody can put the stock to me, making me buy it at $195 per share. But Rob, it's trading at 200. Exactly. Who's going to do that? Nobody. Or what if it drops to 194? Oh, they can make me buy it at 195. Yes, right? Exactly. But what if it drops to 100? Can they still make me buy it? Well, I don't want to buy it. I didn't ask if you want to. I asked, can they make you buy it? And the answer is yes. Well, what if I don't have the cash? You have to bring the cash in. What if I don't have the cash? You want to have the cash, right? Because they're going to ban you, blackball you from trading options again. You want to have the cash, okay? Selling this position just like this is a naked put. You don't want to do that. This scenario helps you, gives you an insurance policy in the market. Yeah, those that say insurance doesn't exist for the stock market, they don't know what they're talking about. If we went ahead now and we bought to open BTO, let's say the $190 put, right? And for that, I don't have a credit, but I have a cost. on that position, cost with a T, not a P, of $1. Right? So what does that bring in for me naturally? Right? Well, naturally, I wind up with a credit, naturally, of $1. How did that happen? I took in 2, which obligated me to take the stock from somebody at $195. I spent $1, which gave me the right to make somebody else buy it at $190. So where's my maximum risk in this trade? My max risk here is $5. What? $5? No, it's not 5. No, max risk is the difference between the strike price that I sold and the strike price that I bought, $5. Right? But where is my risk in the trade? Well, your risk is $5, but what happened? You took $1 in credit. So my risk in this transaction is $4. Right, $4. Well, let's just use 4 and call it a day. All right? My max risk is 5, my risk is 4. So worst case scenario, this stock drops down below 195, somebody's going to make me buy it at 195. I can force somebody to buy it at 190. Well, Rob, what if it drops to $1? Someone's going to make me buy it for 195. I make them buy it for $1. Really? So my maximum I can lose in this trade is $4? Yes. And if you're buying Apple stock, my guess is if you're buying the stock, you have more than a $4 risk you're willing to take on to the downside on the stock. So here I have a maximum risk of $4. And if you look at this, if we do cash in, right? Cash in is my profit over cash out, right, which is my cost. So let's break it down one more time. Cash in is $1, right? Cash out is $4. I need to have $4 of my own money to put in this trade just to set it up. Well, if you do that as a fraction, 1 over 4, what is my rate of return? 1 divided by 4, it's 25%. If I am right in this transaction, in this trade, I am 25% is what my rate of return is going to be on this. Boom! Right? That's why I love selling strategies versus buying strategies. So let me bring over TradeStation and let's talk about setting this up as an example or sample trade. Now keep something in mind. Everything we talk about is for educational purposes. This is not meant to be a trade. I haven't looked at the chart. I haven't identified where things are. I'm going to show you the things I'm going to be looking for and set it up that way. All right, so let's go ahead and bring over Option Station, which is part of TradeStation. I'm using 9.5. Sometimes I use 10, but I still like 9.5 better than 10 at this point. So what we're going to do is we're going to come over to Option Station. Now, we are right now sitting at Thursday when I'm doing this recording. We're not going to have a lot of premium on an option for Apple on a Thursday, right? On this close to the expiration. But we'll see what we can come up with. So the stock is trading at 192.25. I'm just going to go and look down at, let's say, the 187.5, okay? So 187.5 is our lower strike price. That's going to be the one we sell. We want to identify the selling position first. And the way that I like to do this, if you have a stock at 192, I want to go with my one below that, which is my sell, and then do the one below that, which is my buy. I like to lay it all out in a flow and instead of it all being mishmash where it's mixed up. So 192, 190, 185, or 192 in this case, 187.5, and then 185. So back to the chart or the option chain, we're going to go to the 187.5. Right now it's trading at $1.48 by $1.49. Right? What I'm going to do is if you put your mouse on the 148, that's sell. Right? I'm going to click on that sell button right there. Right? Now it's going to load 2 contracts in the bottom here. We're going to change that, but not yet. And you'll see it says sell to open 2 contracts of Apple 4th of August, 187.5 put. Right? And it's got a price in there right now, a limit price of 149. Now, we're not doing that just yet. We're going to go back and the 185 is the next lowest strike price. When we buy an insurance policy, and that's what this is, we're going to go 1 strike lower than we are selling the position at? We sold the 187.5. What's the next lower number? 185. If it was 182.5, whatever it is, the next lower one is the one that I want to choose. So now we go back over there. Again, we put our mouse, see the 88 cents shows as a sell, but the 89 cents shows as a buy. Now here's the important part on TradeStation. You need to hold down the control key. If you do that and click the buy button, ta-da! It keeps both positions in the order bar. If you don't hit control, you're going to replace the first one that you did with the second one. Easy enough to fix, but just keep in mind that's what it is, control. Right? I don't want to trade 2 contracts, I want to trade 1. Now, what I want you to look at is down here, it says natural and mid. It shows the natural price right now, 59 cents. The mid price is 61. Now it's 60 or 61. Right? We are so close, I don't care. But the mid takes the very center of the price. If I take the natural, right, which is only 60 cents, I would take in for credit. The other penny doesn't really mean much to me. I'd rather not potentially miss out on the trade. If you have a bigger spread, I'm going to negotiate and go right after that mid. Apple ain't got no mid. It's too tight of an option. Why? Market makers trade thousands of contracts. I mean, these 2 contracts we're looking at today are like 23,000 contracts traded today, just on these 2 strikes. And forget about it if you go over to some of the other ones. I mean, volume on the call side, well over 100,000 today. So you're going to have tighter spreads on there. So we changed it to 1 contract. I'm going to go with the natural for the credit, okay? And then I would click place order. And what you want to do is make sure that you read this out loud. Yes, people may think you're nuts. I don't care. Reading it out loud, you will catch mistakes that you will not catch if you just read it with your eyes. See, when I'm reading, I use my eyes, right? I can't see that way. Use my eyes. After I've read it, and now I speak it out loud, well, that's a second sense that I'm using. Vision, speaking. Third is hearing, right? And if you're like me, well, I thought I was half Italian. According to 23andMe, I'm 65% Italian. I use my hands. That's another sense, right? This is another language right here for us. Okay, some of you know what I'm talking about. So I'm going to read this out loud. Apple, 4th of August, 23, 187 half, 185 short, put vertical, which is a spread, 59 cent credit limit. Meaning I don't want less than 59 cents. You could give me 60, 61, 80, whatever. Don't give me less than 59, right? We're going to sell to open the 187 and a half. We're going to buy to open the 185. Intelligent order, find the best routing for it. Don't worry about changing any of that. It's for the day only, right? It's not longer. Duration is down here. You could have changed it. We don't want it longer. I want to be in that trade today. Duration is how long to enter the trade. I don't want to enter tomorrow. I want it to be today, right? My profit would be 59 cents. My maximum loss or risk in the trade is $1.91. You could do the exact math, but if you said 50 over $2, it's 25%, right? Put 50 cents out. You need $2 of your own money. $2.50 is the difference of the strikes. Overall, I've got a 25% rate of return. 59-cent credit, estimated $59 for 1 contract. Now, prices changed a little bit. If that happens as you're reading it, you could click no, don't do that. You can go back and click the credit button again to change it. Place order. I've already read it out loud. Click yes. All right. Now it says on the bottom, we bought 1 August 23 185 put at 58 cents, right? 82 cents. So we got filled on our 58 cents there. All right. We got the execution the way that we wanted to. It's just the way 1 contract went through that we bought, 1 contract that went through and we sold. I don't care what the price was. I said, give me 58 cents or more, or don't do the dang trade, right? And that's exactly where we're at. And voila, you set up a credit spread. And there you have it. Credit spreads, a powerful tool in your options trading arsenal that can allow you to get paid to trade. It's one of my absolute favorite cash flow strategies. Always remember, while they offer a high probability of small gains, they also come with risks. So be sure to understand your own personal risk profile and risk tolerance so you can manage these risks effectively. With that, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it. And remember, you're just 1 trade away. Go ahead and check out some of our other great content right here.